Hi everybody, Luke Fannin here from Athlone Institute of Technology, and we are looking at this document prepared by PwC back in May 2017 titled Understanding a Financial Statement Audit. And it's a useful document because in nice plain English, easy to understand language, it goes through a lot of the elements of auditing. So why do we need an audit? What's the role of an audit? And one of the benefits or one of the reasons we have an audit is to give assurance or confidence to the owners of companies that the management have prepared the financial statements correctly, that the financial statements give a true and fair view of the company's financial performance, which is their income statement or profit and loss account, and position, which is their assets and liabilities, the balance sheet or statement of financial position. So an audit, we're not going to get into it now, but in terms of corporate governance, an external audit is very important because you've got an independent person outside of the company checking the work of the management, the directors, the executive directors of the company in their preparation of the financial statements. And it comes back to issues such as stewardship, accountability, agency theory, all corporate governance issues, which we're not going to get into now, but we will later as we go through the course. And the big thing is the auditor is independent. Then the definition of an audit, and it gives a general definition here, which is easy to understand: an evaluation of a subject matter. So someone looking at subject matter with a view to express an opinion on whether the subject matter is fairly presented. So we in this course are just interested in the audit of financial statements, as is this publication. So there are other types of audits, but we're looking at audit of financial statements. So a definition of a financial statement audit is: a financial statement audit consists of an evaluation of a set of financial statements with a view to express an opinion. So that's the auditor's opinion, which is given in the audit report. So with a view to express an opinion on whether the financial statements are fairly presented. And normally the auditor's opinion at the very end of the audit is, in our opinion, the financial statements are true and fair. But where there are material problems, or the auditor's opinion will differ from that. They might say, in our opinion, the financial statements are true and fair, except for these particular areas. Or there maybe if there are bigger problems, the report would be different, or the opinion will be different. And just as nice wording here, people often see GAAP and GAS, particularly GAAP, and not sure what it means. So if we look at that, GAAP is generally accepted accounting principles, or sometimes even generally accepted accounting practice. But what it means is companies prepare the financial statements in accordance with a framework of generally accepted accounting principles relevant to their country. So that might be a mix of accounting standards and local legislation. There may be industry type legislation, maybe banking legislation or banking regulation. All of these things impact on the financial statements, and they form the generally accepted accounting principles, or sometimes generally accepted accounting practice, GAAP. And the auditors, when the auditor is checking or evaluating, giving their opinion on whether the financial statements are fairly presented, they're taking into account what are the generally accepted accounting practice for that company, for that country. And also the auditors will use auditing standards when they're carrying out their audit. So the purpose of a financial statement audit, and one of the reasons that we need external auditors, is the separation of ownership and control. In large companies, the owners are the shareholders, the people who run the company are the directors, but there's a separation between those two bodies of people. So the owners take comfort from the independent assurance. So it's an assurance engagement. So a qualified external party, the auditor, is engaged to examine or evaluate the financial statements, to give their opinion on whether the financial statements are in accordance with relevant GAAP. One important factor is that auditors are generally appointed by the shareholders. So the shareholders vote at AGM, their annual general meeting, to appoint auditors. Now, the directors probably will recommend auditors, and they will stay in position for a number of years, but it's the shareholders that make the decision in terms of appointing the auditors. So the auditors work for the shareholders, who are the owners, and they're evaluating the work of the directors. And it gives some other benefits there. It mentions public versus private companies. Most private companies would be smaller than a public companies. And the biggest issue, I suppose, is larger public company audits are more complex than private companies. And that's common sense, so we won't go into that in any much more detail. This mentions the audit environment, and it's important just to realize that as well as looking at the company's set of financial statements, an auditor has to take into account legal and economic environment, because, as I say, there's implications for a company's operations in terms of maybe their going concern, in terms of provisions that are created. Are they realistic? The provisions, do they reflect the economic environment? COVID, for example, what happened with COVID-19, that really impacted on financial statements. So all of these, so the auditor has to look at, as well as that, laws and regulations. So that's what this is explaining here. And this infographic is here to talk a bit more about it. And it just mentions the regulatory body for auditing standards. As I said, the end point of an auditor, one of the purposes of an audit is to get an independent person to give an opinion. So the opinion is given in the audit report. So in a set of financial statements, you have the financial statements, which are the income statement, the statement of financial position, and the accompanying documents and notes. And as part of that, then you'll have the auditor's report attached to that, and the auditor will give their opinion. So be very clear, the management of the company prepare financial statements. That's really important. The auditor is responsible for the opinion that the audit has been conducted in a way that the auditor has reasonable assurance that the financial statements are true and fair. So we'll be going into that in more detail, but we'll skip to the audit opinion, and the auditor issues a clean or an unmodified audit opinion where it concludes that the financial statements are free from material misstatement, and that opinion will look like, in our opinion, the financial statements are true and fair. So here is an example of an auditor's report, and it's on the Glanbia PLC financial statements for the year ended. It's in 2020. So here's the auditor's report. In our opinion, the group and company financial statements give a true and fair view of the assets, liabilities, and financial position, and also of the profit of the group. So that's a clean audit report, or a non-modified audit report. And they're saying the accounts have been prepared in accordance with the relevant financial reporting frameworks and the Companies Act. So that's all the GAAP, the general accepted accounting practice or principles in the region, in the country. And then they tell us what they audited. On the financial reporting framework, they explain what that was. International Financial Reporting Standards, but the main thing is it given at the very start, the opinion. That's the key thing. And if there was a modified opinion where there was a problem with the financial statements, that opinion would be different. But we're not going to look at them now. And there are a number of pages in an audit that go on to explain the responsibilities of directors, responsibilities of auditors, what an audit entails. We're going to skip that and just go to the end. So later on, we'll be looking at audit reports in more detail and things like key audit matters, which are a good development in audit reports. But here at the very end, they say the report is made to the company's members, the shareholders, and it's signed by probably the partner, the engagement partner for Glanbia, Kevin Sheehan, and there's stated. And the next page after that is the income statement. So there are the financial statements. The audit report is part of that, where the opinion is given, and then there's the financial statements. And any shareholder looking at this then has assurance or confidence that these figures are true and fair, that they represent the revenue, that there's nothing made up, that it's not too little or too much. And we'll go into the assertions. So one of the really important things that you need to know are the financial statement assertions, and we'll be coming back to that again and again. So we're back to the PwC report, and here's once again saying the audit opinion is clearly stated as a separate paragraph. So that's it there. And then it mentions if there are any modified opinions are here. So unmodified is a clean audit report, and modified is where there's an issue that's deemed important enough or material enough to be brought to the shareholders, the reader's attention. We're not going to get into that we will in a lot of detail later on, but there's that talks about it there. The going concern assumption is important. It's one of the basic underlying concepts, and you should have a good idea of what is meant by going concern. So a company is a going concern if it will continue business for the foreseeable future. And what we're talking about there is 12 months. So 1 year in advance. And it says there, when the use of the going concern assumption is appropriate, assets and liabilities are recorded on the basis, they'll still be carried on historic cost basis, less depreciation, and they'll be able to pay off its liabilities. Of course, if it's not a going concern, then a lot of things would need to change in the financial statements. So the company may need to write down assets from historic cost to break up value. What would they get if it's going to be sold in the next 12 months? So assets could reduce dramatically. You could have other costs such as liquidation costs, redundancy costs. All these have to be provided for. Liabilities, there may be additional liabilities. The company may not be able to pay off its liabilities, may need to highlight that. So the financial statements would need to be changed quite drastically if it's not a going concern, if the company or management thought the business would not be in operation for the next 12 months. So that's why this is really important. It's the management that make the decision on whether the company is a going concern. When I talk about management, I'm talking about the executive directors and the CEO, the financial director, the head financial accountant, the person responsible for the financial reporting. They're any other executive directors. They make a decision on the going concern, and the auditor does need to check that. We'll just see. It's the auditor's responsibility to consider whether there are any material uncertainties affecting management's assessment. So these all impact on the audit report, but you don't need to get into, at this stage, start the course, don't worry too much about in too much detail, but you should have an idea what is meant by going concern and why it is important. The Carillion collapse in the UK is a good example of a going concern scandal where a company collapsed unexpectedly, and perhaps the auditors should have, or the management's assessment of going concern wasn't correct, and the auditors maybe should have reported on that. So it's still been played out. So here back in 2018, here is the the Times and there's the heading Carillion Auditors Under Fire, and questions over the clean bill of health from KPMG. So Carillion was a building construction company. And if you wish to read more about that, there's a lot out there. Okay, there are 4 pages left in this, and most of it deals with the audit process. And the audit process and PwC here have kind of categorized it into 5 different phases where the audit has been planning the audit, risk assessment, where the auditor identifies the areas of the financial statements that are most likely to be materially misstated, because it makes more sense for the auditors to direct more of their testing to the areas of the financial statements that will be incorrect or could be incorrect. Then out of the risk assessment, where the auditor has identified the riskiest areas, and we'll do a lot on risk assessment, the audit strategy and plan. Then the actual gathering of evidence, which is internal controls testing. So you gather evidence on the internal controls, and we'll look at that. And the other type of evidence you gather is verifying or substantiating the figures in the financial statements, and that's called substantive testing. So the two types of evidence that are gathered. One is evidence over internal controls. That's one large part of the course. And then once the auditors receive the draft accounts, draft financial statements, they need to prove that the figures in the financial statements are correct. So for example, in the Glanbia PLC for 2020, year ended January 2020, 2nd of January, it's a funny date, revenue 3823.1. So the auditor needs to get evidence that that figure is correct, that it's complete, it's not missing anything, that all the transactions actually occurred, that they represent genuine items that are business transactions, that's nothing made up. The cutoff is correct, that they're recorded in the right year, that some of this revenue doesn't relate to last year or future years, that it's all just related to the year ended January 2020. So cutoff is another way of looking at the expenses and income in a set of accounts. And then also, has it been calculated accurately? You know, for a company that's registered for VAT, there should be no VAT, for example, recorded in revenue. It's always the net amount where the correct price is charged. Does that revenue represent the correct price that was agreed with customers? So there's lots, and there's some other assertions. And when we go to the balance sheet, and we've got assets and liabilities, you have the same type of assertions, some slight difference. If we look at property, plant, and equipment, is that figure complete? What are the chances? You know, the auditor needs to gain evidence that it's not missing. There's no unrecorded assets that should have been. So should that figure be bigger? Then also existence at the 2nd of January at the 2021. Do these assets exist? They're not made up, basically. So existence is an important assertion. Related to accuracy, so where we looked at was revenue calculated accurately. When we look at property, plant, equipment, is it valued correctly? And when we look at valuation, we look at the historical cost, what was included as the cost. It should be capital items, no repairs, no revenue items such as repairs. So capital and revenue issues come in there. Also depreciation. Is depreciation calculated correctly? Is the depreciation policy appropriate? Is the length of life of the assets appropriate? So the auditor has to look at those things. And we look at the assertions, but that's what we're talking about when we look at gathering evidence, when we look at substantive testing. So substantive testing is the auditor trying to substantiate or verify the figures in the financial statements. And you do that by looking at invoices, by recalculation of depreciation, by looking at the policy for depreciation, assessing whether the useful life is appropriate when you look at actually how long the assets are in use. So there's lots of ways of substantiating the figures, and we'll be looking at them in more detail as we go through the course. And the other way of gathering evidence was internal controls, and that doesn't really... Internal controls, if you're testing internal controls, you don't start off from the financial statements. You're looking at the processes, the policies that are in place in the company. So you're not starting from the financial statements. You're going to for example, you're looking at the purchasing department, and you're saying, when we purchase property, plant, and equipment, how are they classified as capital purchases? How is the classification made between capital and revenue? How do we ensure that the property is bought in accordance with the policies of the company, which would be to buy things at a not too an expensive rate, to have good quality assets purchased? So we'll look at internal control testing separately. But that's what gathering evidence is there, is internal control testing, which will be 1 or 2 separate chapters for us, and then substantive testing, which is quite a large part of the module. And then finalization is where the auditor kind of reviews the accounts after they've gathered the evidence and prepares the audit opinion and any other outstanding issues. And we're not going to get into that in any detail. So professional judgment and skepticism, you should have an idea what that is. So it tells that the auditor should have professional skepticism. So here, auditing standards require auditors to maintain professional skepticism, and you should know what that is. A questioning mind and a critical assessment of audit evidence. So particularly when you're looking at subjective areas around valuations or assumptions about the future, about going concern, about provisions, about if an item is capital in nature or revenue in nature, the auditor needs to question and also critically assess any answers they get, any evidence that they obtain. And professional judgment is the auditor using their experience and their knowledge, and as they gain more experience, their professional judgment should improve. But the big one for us, and you should know it, is professional skepticism. So have a good idea of what that means. Limitations of an audit, they're outlined here. It's a small part of the course. There are some limitations, so you can take a read of them yourself, but it would never be a large part of any question in an exam. So just have an idea of some limitations, 3 or 4. Now, auditor's responsibility in relation to fraud. Reasonable assurance financial statements. So it's the management responsible. So that's the auditor's responsibility, just for gaining reasonable assurance that financial statements are not materially misstated by fraud, whereas management, they are the ones responsible for preventing and detecting fraud. So there is a difference there, and you need to know that. And if the auditors have suspicions in relation that there may be fraud, well, then this will change the audit plan. The risk assessment will change, and then when the risk assessment changes, the strategy changes, and they might need to gain more evidence. They might need to gain more evidence over internal controls, or more evidence, probably substantive testing, a higher level of testing in certain areas. So gathering evidence is a large part of the module, and as I said, it's two main areas in that. One is internal controls testing, and the other is substantive testing. So controls testing, as mentioned here, is outlined. So most businesses will have their own systems and controls to operate efficiently, safeguard its assets, and to provide reasonable assurance. So there'll be rules and processes in place. And the auditors assess the effectiveness of these rules and procedures. And if internal controls are good, are strong, and the auditors have tested them and they've gained evidence that they operated effectively through the year, then the auditor can place more reliance on the figures in the financial statements. So if we look here at Glanbia, and let's go back to there has to be a typo here, 2021, 2019. But anyway, the controls around revenue. So if you go to the sales department as auditors, and they go into the sales department and they find that, I'm not looking at Glanbia here, but about any company, that during the year, a couple of the key sales personnel were sick with COVID, and temporary people had to be brought in. There was no real supervision of the work, no proper supervision, and they go looking at some of the underlying records, and they find that incorrect prices were charged, maybe that some of the revenue was booked for next year was booked for this year. If they see that internal controls were poor, well, then this figure is probably less reliable. Whereas if they went into the sales department and they saw that it was very well run, it was, there was effective supervision of work, there was proper rules and procedures and policies in place, that the computer system was good, and that it had strong controls, and that it booked revenue accordingly in the proper year, well, then this figure is probably more reliable. And what that means is if the figure is more reliable, then the auditors have less substantive testing to do at the end. And the substantive testing, trying to prove the figures are right, is the one that takes up the most time. And it said even if the controls are reliable, degrees of substantive audit evidence, you'll always need to do substantive testing. The next page then explains substantive testing. We'll be looking at this in detail, but just for now, it's important for you to know internal controls and testing. And these are examples of substantive tests. So in addition to testing controls, the auditor needs to perform further procedures to gather evidence from substantive procedures. But what that really means is the auditor needs to look at the figures in the financial statements and get evidence that they are correct, that they're not materially misstated, that there's no material misstatements in them, that they're true and fair. So how you do that is through a range of procedures, examining records to support balances and transactions. So transactions are the income transactions and the expense transactions in the P&L account or the income statement, and balances are the items in the statement of financial position. So when it says there are balances and transactions, balances is the statement of financial position, transactions is the income statement. So records, so for example, records to support revenue, a lot of the records will be the sales invoices. will be the sales order forms, will be dispatch notes, were the goods dispatched. We can only book revenue if the customer has received, if the goods have been dispatched, customer has received them. So customer signature, proof that the items were delivered. The other important records to look would be the authorized sales price list to make sure that the correct prices were charged. If we look at maybe there, so these are all transactions. That's the sum of every sales transaction during the year. That's the sum of all the finance costs, all the interest costs during the year. If we go to the balance sheet or the statement of financial position, these are balances. This is the balance of property, plant and equipment that was owned at the 2nd of January 2021. So underlying items that will be, underlying documents that will be examined will be, particularly if they're purchased during the year, will be the purchase invoices for any plant and equipment. Insurance documents, perhaps. The depreciation policy of the company. Other things that are done with physically observing or inspecting assets, so they'd inspect a sample of the plant and equipment, and also all of these things is you won't be able to inspect every invoice, every support, so you select a sample. The same with sales, you only inspect a sample of the transactions. So physically observing or inspecting assets, and that'll give you evidence over the existence of the assets and also some evidence over the valuation. Examining invoices in relation to sales invoices and invoices to purchase invoice of assets gives evidence over the accuracy of sales and the valuation of the assets that they're recorded at their correct cost. Confirmations from third parties, suppliers, customers, so large. If we look at the current assets at trade and other receivables, the auditor may need to organise a receivables circularisation where the company writes out to its receivables is managed by the auditor to verify the amounts owed. So that's getting confirmations from third parties. Same with bank. Do we have any bank cash and cash equivalents here? The auditor will request through the company that the bank provide confirmation of the amounts in bank accounts and any bank loans and any finance charge during the year. Inventories. Most inventories will be held on site, but sometimes inventories may be with third parties on a sale or return basis. Consignment stock. There can be different agreements with inventory, so sometimes auditors may need to get confirmations from third parties to confirm how much inventory is there, the state of it if it's valued correctly. And then checking calculations. So checking calculations, a very simple one, is looking at recalculating depreciation of property, plant and equipment. If there's a bad debt provision, recalculating current tax assets, kind of recalculating the calculations used to determine if there were deferred tax assets. And then there's finalization. The audit committee is a part of corporate governance. It's part of the company. It's one of the internal controls in a large company. So if you see the audit committee, it's not the auditor. It's not part of the external auditor. It's part of the company being audited, and in public companies, that's important. So in public companies, they form an audit committee, which is normally made up of some of their non-executive directors. It's acting as a largely independent body, but they're directors who are there on a non-executive basis, and they're there to represent the shareholders' interest. And so when we look at corporate governance, we'll see more about audit committee, why it's important, and how they interact with the audit firm. So, as I said, it's a corporate governance committee, and usually responsible for overseeing the audit and evaluating the independence and performance of the auditors, and also for assessing the internal controls of the company and that the financial accounts were prepared properly. Another part of the module is to do with auditor independence, ethics in audit. And we said it's important. One of the reasons that we need an audit is the shareholders need someone independent to come in and review the work of the directors in preparing the financial statements and give an opinion on that. So if we look at this, auditors need to be free from bias and without being influenced by management to prepare the financial statements. So it's important. And some of the scandals that have occurred, some of the big scandals, rules have been brought in following the scandals because lessons have been learned that auditors were either being influenced by management or they were biased in the results because, one, they were too familiar with management. They'd lost their professional skepticism. They were auditors for too long, for example. They might have been auditors for 20 years. And at that point, at what point do you stop losing your professional skepticism, your questioning attitude, your critical assessment of what the directors tell you when you've been there, when you've been there meeting them every year for 20 years. So there's rules were brought in to say how long you could be external auditor. And most of these rules apply to public company audits or significant companies that are being audited. So familiarity was a problem, over-familiarity, self-interest, over-reliance on fees from a large client. Another issue that came out after some scandals, such as Enron, WorldCom. For example, some American scandals were that auditors were providing non-audit services. And then these non-audit services did have an impact on the financial statements. And so auditors were assessing their own work, which is never a good idea to have someone giving an opinion on parts of their own work. So other types of influence might be if auditors got too involved in advocacy, in acting as a witness in a court case for a company. So advocacy we look at, it's not one of the large ones. The big ones are familiarity, self-interest, self-review. They were the three biggest problems, I would say. And then intimidation and advocacy are some of the smaller ones. So that gives examples. So preventing the auditors from holding an interest in. That makes sense. You can't own shares because you have an interest in the company doing well. Prohibiting the auditors from providing the company with non-audit services that could compromise their objectivity. Rotating audit personnel, and then even rotation of the audit partner, and then rotation of the audit firm. So this rotation of lead audit partner is to do with to stop auditors becoming over-familiar, over-friendly with clients, audit clients, and then what happens is they lose the professional skepticism. Non-audit services, so that's to do with self-review. The auditors end up reviewing their own work, which is a problem. And then self-interest, here this one is self-interest, or auditors having a financial interest or a benefit of the company doing well. And that's to do with things like earning too high of fees. Earning very high fee from one client in comparison to the rest of the audit clients, becoming over-reliant on one client for fees. Earning high fees from non-audit services. So an audit firm may not want to give a bad audit opinion or a modified audit opinion because they might lose the fees earned from other services, non-audit services. And then contingent fees, where you're never allowed as auditor charge a fee where the fee would be a percentage of profit or percentage of revenue. So we'll look at these as a chapter on this. It comes up a lot in the exams where you have to identify issues and then respond. So independence of the auditor is important. So you need to know the threats to independence and then the safeguards on how to deal with those threats. Auditor appointment is a relatively small area. Once again, there's some specific rules. They're mentioned, some of them here. They'll be dealt with in the book. And this, not really a large part either. Becoming a challenging process, academic study and learning on the job. So you know yourself, you'll have 3 years post qualification before you can sign off on accounts, and you have to work in an auditing firm and do approved audit work to gain an audit practicing certificate. And then it talks about multi-location audits and problems with that, which is very specific to, I suppose, a lot of the audits that PwC would do. Any audit of a large company will have multi-location audits. So we won't get into that now. We'll just, what does it say down here? But I wouldn't worry about that now. It's just interesting. Here is the glossary, which is this, and you should know generally accepted accounting, I keep it for practice, but principles. Okay, the AGM, the annual report. Here's Glomby's annual report and financial statements for 2020. It's very confusing. Why is the year ended 2nd of January? Why don't they have it the year ended 31st of December? I don't know. But the annual report and financial statements. So the financial statements is just a small part of it. So here, financial statements. This is what the auditor looks at. These areas: the group financial statements, the notes, and the company financial statements. And the annual report is all of the whole thing together, but the auditor's focus is on the financial statements. And there is some element where you do have to look as auditor at these areas to make sure they're consistent with the financial statements. And we look at that when we get to the audit report, because it can have an impact on the audit report. If, for example, the financial statements said there was a loss of X, but the chairperson's report said that the company made a profit, or said was not consistent. So, but really our focus as auditor is on the financial statements and the notes. And you can see there are 226 pages, but you know the financial statements are a small part of it. But the annual report has all these things in it. And for us as auditors, or as even students, we need to have an idea of corporate governance. And we'll be looking at some of the reports because it helps explain it as well. And these assurance. So an external audit is an assurance engagement, enhancing the user's confidence in the information that's been reported. So the auditor obtains reasonable assurance about whether the financial statements are free, and gets that by gaining evidence through internal control testing and substantive testing. And then assurance gives confidence to the users of the accounts. Audit committee is a committee of the company, so it's not part of the audit firm. That's important just to get that from the start. And once you understand that, then you can get more information. And a majority of independent, non-executive directors. That's its makeup. The audit report is the outcome of the audit. It's the output. Now, there are some outputs where the auditor might write a letter to the management of the company outlining internal control weaknesses, but the main output is the audit report and the audit opinion. And here, if we look at Glanbia, here's the audit report on page 127, and it goes to 136. So you can see it's quite substantial. We looked at the first page already, and that's the key one where the opinion is given. States the audit's conclusion on what are the financial statements, and it can be unmodified or modified. Unmodified means a clean audit report. In our opinion, the accounts are true and fair. Modified means there is a problem with the financial statements. Something is incorrect, or either it's incorrect or there's not enough evidence about something in the financial statements. So we couldn't get enough assurance, we couldn't get enough evidence. And it's different degrees of modifications. So particularly for a public company, any type of modification is an embarrassment and would be seen as being quite negative for the management. So most reports would be unmodified. Like to explain a bit better, if a company considers they're a going concern, the management will do their going concern assessment, and then they may decide that there is a material uncertainty, that there is some issue which does cast a doubt over a going concern, and they're bringing it to the shareholders' attention. And the auditor will look at that and agree. If the auditor agrees with that, they'll give an unmodified audit report. And that is no problem, but the problem arises where if a company fails to highlight an uncertainty, material uncertainty about going concern, and then the auditor disagrees and says, in our opinion, the financial statements are true and fair, except for the failure of management to highlight this uncertainty about going concern. But that would have been highlighted to management before the opinion was given. There'd be a lot of discussion. Management would be given time to correct the financial statements. And so normally modifications only really happen where there's a big disagreement with company management and the auditors. And often it doesn't lead to a good working relationship after that. So auditing standards, you don't need to know that much about them, only for the fact that they're there. We don't have open book exams. If we had open book exams, you would need to be a bit more familiar and know the particular auditing standards. But with the closed book exam, it's unreasonable to expect people to know the numbers of the auditing standards. But what you do need to know is I suppose we'll see it as we go through, is how these impact on the auditor's work, and we'll be doing that as we go through the course. Breakup basis to do a going concern. So if a company is not a going concern, the accounts are prepared on the breakup basis. Assets and liabilities are included at the resale value or forced sale or liquidation, which means assets would drop in value more than likely. And liabilities, I suppose it depends. But definitely there'll be some extra liabilities in an event of a breakup. Disclosures are notes. So these are just the notes to the financial statements. If we go to Glanbia, notes to the financial statements, page 141, they're the disclosures. So here are the disclosures, financial statements it's the year ended 2nd of January 2021, but that really is for 2020, for the year 2020. And for the life of me, I can't understand why they're doing that, why they just didn't go the year ended 31st of December 2020, but anyway. And it goes through significant accounting policies. The directors have a reasonable expectation that the group has resources continuing operational existence for 12 months from the date of approval of the financial statements. So that's even, so if the year end is 2nd of January 2021. These statements mightn't be approved until March, April. It'll be the date of the audit report nearly, won't it? Sorry, if we go up, the 23rd of February was the date the directors approved the accounts. So that's 12 months from then they're looking at being in existence. And therefore the group continues it appropriate to adopt the going concern basis. And lots of other disclosures, so there'll be, just want to get down, there'll be details of the apologies for all that clicking, but the notes, there'll be a combination of written disclosures, and then there'll be breakdowns of items in the financial statement. So here, more detail given on the items in the income statement. And the auditors have to look at these, audit these as well, to check that the disclosures are true and fair. So as well, so it's all of these that form part of the financial statements that are being audited. Emphasis of matter, it's to do with the audit opinion in the audit report, so don't worry about it now at the moment. It's just getting more detail on the audit report, which you don't need at this stage. Financial statements. On generally balance sheet, income statement, cash flow statement, and statement of changes in equity, and then the disclosures, the notes. Going concern, I said you need to know, you should have a good idea what going concern is. The income statement is made up of transactions. So when later we'll be referring to them as transactions, and transactions are different to balances. Balances are in the balance sheet. Transactions in the income statement, it's the sum of all transactions from the start of the year, from the 1st of January to the 31st of December. So all the sales transactions that occurred are added up. That gives you your total sales. So it's transactions in the income statement, and in the balance sheet, it's just balances at the year end. So it's just what's there at the last day of the year. Internal control systems. So internal control systems, and we'll be looking at that in detail. So you need to know, we'll be looking at internal control systems such as the sales system, purchase system, inventory system, payroll system. So we divide the company up into different areas that impact on the financial statements. The purchasing system in terms of capital purchases as well, in terms of the capital items in the balance sheet. A listed company, so we'll be looking at that. So you need to know what good practice is in these control systems, and then also how you would test them and what to do if you find weaknesses. So we'll be looking at that in detail. A listed company, a public listed company, so we call them sometimes PLCs. Materiality. So a non-modified opinion is given, a clean audit report is given, or when the auditor expresses the opinion that they've gained assurance, reasonable assurance, that the financial statements are true and fair. However, if there's a material misstatement, then the auditors issue a modified opinion. So material, what is material? So it helps determine what information is important. So at what point does a misstatement become material? And this tells you here. So quantitative measure, oftentimes an item is material if it's greater than 5% of the profit before tax. So that's a quantitative measure. A qualitative measure means not related to money, but it's related to other items. So if there were misstatements in directors' transactions, related party transactions during the year, for example, or directors' remuneration, even if the amount is quite small, that item would be material because of the nature. It's a qualitative measure of materiality, because shareholders always want to know the full facts of directors' remuneration packages, because directors have so much power and shareholders will be afraid of abuse of that. So a misstatement, we said if there's a material misstatement, then that leads to a modified audit opinion. So a misstatement is where the figure in the financial statements is incorrect. And here are the modifications to the report. We'll be looking at them in detail. You don't need to really look at them now, but you will need to know them and know them well by the end of the semester, but not at this stage at the beginning. So reasonable assurance is the degree to which the auditor needs to gain enough evidence. So high but not absolute. So it's not 100% guarantee. So auditors' defense often has been that they've carried out their audits in accordance with auditing standards. And if that's been the case, then they will have had a high level of assurance. And then if a scandal occurred, the auditors will say, well, it was only reasonable. It was a high level of assurance, but not absolute. So we weren't giving 100% guarantee that the accounts were correct. So auditors can argue that they got reasonable assurance if they comply with the auditing standards. So that's why it's important for you to know auditing standards and for auditors to know the auditing standards and to comply with them, because if they don't, then they won't have had reasonable assurance and they're leaving themselves open then to being sued or being disciplined by regulators if there turns out to be material misstatements in the financial statements that they didn't pick up. Regulatory bodies are important. In Ireland, we have the IAASA. So in terms of regulators, the Financial Reporting Council are the regulators in the UK for auditors, accountants and actuaries, and then in terms of corporate governance and stewardship codes. And the UK Corporate Governance Code is very influential worldwide, and we'll be looking at that as part of the module. So the Financial Reporting Council are very influential. And in Ireland, we have the, in Ireland, we have the Irish Auditing and Accounting Supervisory Authority. So it's a bit of a mouthful. I wasn't sure whether it was auditing and accounting or accounting and auditing, but here we are. So in terms of regulatory bodies that impact on auditors, these are responsible for listed entities, for examination enforcement, oversight of the recognised accountancy bodies, so ACCA, CPA, chartered accountants, so certified accountants, chartered accountants and certified public accountants are overseen, regulated by the IAASA. Previously they weren't, but because of accounting standards and scandals, because of scandals throughout the world, the professional bodies fell under regulation. Previously they were self-regulated and do a lot of regulation themselves of their own members, but in many countries a regulatory body did take over regulation of the professional bodies. So the recognised accountancy bodies are the professional bodies, ACCA, CPA and ACA. And so they're the regulators of most interest to us in this side of the around Ireland, the IASA, and then in terms of the FRC, more so to do with the corporate governance side of things, but also because they're very influential worldwide, the Financial Reporting Council, even in terms of accounting standards. Substantive audit evidence, you need to know this, and we'll be doing a lot of work on this. So for now, you just need to know the difference between substantive audit evidence and internal control testing. And for substantive audit evidence or substantive testing, you're trying to substantiate the figures in the financial statement. So your starting point is the figure in the financial statement, and how do I get evidence to prove to get reasonable assurance that the figure is correct. So for a sample of the transactions, you'll be looking at underlying documents, you'll be inspecting physical assets where you can, you'll be doing calculations, you'll be doing analytical review, which is looking at things like ratios, trends, relationships between accounts such as property, plant and equipment, and depreciation. There might be normally every year there'll be a certain percentage link, and you could, on a rough, so analytical review is part of substantive procedures, and we'll look at that as well later on. True and fair. So no precise definition, so that they're prepared, that the figure is correct, I suppose. So there must be quality and quantity, okay. Working capital, should know that. Deducting current liabilities and current assets. We must be near the end of this. We are on here at PwC. So thanks for that, PwC. Thanks to you for watching. It went on a bit, but it provides an overview of audit. It's a good introduction. And listen, I hope this was useful. So we will talk to you in class. Have a nice day.